Hello, everyone, and welcome back to this Family Building Society podcast talking about later life lending. In our previous episode, we just did a current outlook of the market with key opportunities and challenges. In this episode, we're going to be doing a deeper dive into products that brokers may not have considered it for the later life lending space, and also taking a closer look at product innovation and what the lender landscape looks like. So I want to welcome back Neil Cadwallader and
Right.
Stuart Heavens from Family Building Society. Welcome back. To kick off this section, we did touch on it in our previous episode, which I would recommend that you all watch because it's very interesting, about what products that can be used to help later life lending borrowers that brokers may not have considered. In the previous episode, we talked about interest only and joint borrower sole proprietor and repayment mortgages. I don't know if there are any other products that you would add to that list, or if you want to kind of just remind our viewers of why these products would be suitable for later life borrowers.
When you look at our kind of product stream, because we are different to your normal later life lending kind of lender out there as such, because they primarily will use later life lending products, equity release, RIOs, that sort of stuff. And albeit, yep, we've got a RIO in our kind of a kit bag, and we're quite happy to use that. We do tend to rely quite heavily on normal high street interest only lending, and the reason for that is basically simply the affordability can be worked out on 4 applicants, 4 incomes, where if you've got a joint case or more on a RIO, it does not, because there'll be that death calculation. So it's a remain the man kind of calculation. Then you've got things like, our interest only is a high street lending product, ERCs, 2-year, 5-year fixed. It's a flexible product. It's well priced. And doesn't matter what product you need or what you've got, it's the underwriting and the human element behind it as well. Because these cases can be quite complex, hence why the high street kind of doesn't do it. And that's where our underwriters come in and help on that. And the other one that's kind of primarily used is joint borrower sole proprietor. Now that sometimes is later life lending, and it can be kind of like turned on its head a little bit, because a lot of the time the actual supporting person is the later life lending person, and the high street there, that falls foul at the fact that they don't have the upper age limits, and where we can take a supporting later life lending person to 95 years of age, gives the younger person a longer term, cheaper, or you can flip it on its head. You can have a younger person who's supporting an older person, keeping them in their home, keeping the price down, and supporting them later in life. So, and kind of, if you think about it in a way, you do need that manual underwriting piece in the background, because you can't just put the facts into a computer and it spits out an AIP, decision in principle, call it what you will. You need somebody that can get under the bonnet and look at what's actually happening in the background, and that's where family comes in.
I think that reverse joint borrower sole proprietor is really interesting, because I think there's a preconception that it only works in one way, whereas actually it can work in both directions. Stuart, I don't know if you wanted to kind of if there are any other products that you would kind of shout, I would say like non-standard or high street products that can be used in this context.
I was just going to add, first of all, to the JBSP conversation, because when discussing later life, it would be very remiss of me to not mention things like the equity relief or lifetime mortgages. Just because as a lender we don't provide them doesn't mean it's not a suitable option for clients out there. And obviously, mortgage advisors and financial advisors will need to look at the breadth of products available to their clients to make sure that they're giving appropriate and holistic advice. Now, when it comes to things like the lifetime mortgages, part of that process would be, one would assume, including their kind of next of kins or children to make sure in the conversation to make sure that they're happy, because it could be their inheritance that's being eaten into, for example. And that's a prime opportunity then to have that conversation around joint borrower sole proprietor. If they want their parents to go down the equity release or lifetime mortgage route and roll up the interest, fantastic. If they don't, and they're happy and willing to support the monthly payments that the parents might not be able to afford, which is why they're looking at the lifetime mortgage route, then joint borrower sole proprietor may then enter the conversation further down the line. It may be a way of them supporting their parents, because yes, it's typically for supporting first-time buyers. We all know that, and that's quite a familiar one. But there's a growing number of reasons why someone might need support later in life. It might be that they are that they've retired and that their income has dropped from when they were of working age. They can't afford the mortgage that they used to have. It might be that one of them has passed away and they've now only got one income, because they can be a bit older during this process. It might be that they're silver splitters and they're splitting up. They can't quite afford to capital raise to buy out the other person. There's a growing number of reasons why someone might need to access equity at that stage of their life, and the children can support that, particularly if the children aren't on board with the lifetime mortgage route. I feel it's key to make sure that we are mentioning that there is a breadth of products available. I'm not going to sit here and say that our solution is always the right solution, because I know that there'll be people in the comment section that will be making that clear. But from my perspective, if that conversation does go down the route of the family member not being happy, by all means, they can help out, they can support, they can come on the mortgage with us, and we're more than happy to entertain that conversation. From our perspective in particular, it's the joint borrower sole proprietor side of things that can help with the affordability if it's not working on interest only or repayment. But there are other options available out there as well. So obviously there's the hybrid options that we don't necessarily cater for, but there are other lenders in our space that do. Equally, offset mortgages it's not something that we offer ourselves anymore either. But again, there are other lenders in this space that will be potentially able to look at offset mortgages for those that have that. So there are a range of products available. Obviously, from my perspective, my key focus is family.
Yeah, I suppose it's the takeaway seems to be is like, obviously we're not saying that later life products are not appropriate. I suppose it's just you looking at everything holistically and having a lot of different product routes that you can go down, rather than just being like, oh, they're an older borrower, they're going to go down the equity release, the Rio, that route. Then actually just maybe thinking about, okay, equity release could be very good, but or maybe we need to think about other options as well. It's making sure that you have multiple options that you can pick from, and then that will also, I suppose, feed into consumer duty as well, that you're considering everything rather than just one route. And I know that the later life lending products are there's a lot of pros to them, but there are some cons to them. And I think Neil, you were talking about how some of the high street products, they have a bit more flexibility, they have a little bit more, and the pricing's a bit better. I don't know if we could kind of look into more of what the drawbacks might be of traditional later life lending products, and whether there's more product innovation that's needed to kind of maybe have a look at those deals to make sure that they're kind of going to cater for that growing demand.
But definitely, I think so. And as you just already alluded to, and we've spoken in our previous podcasts, is that we may not be the end game. We may be just part of the journey, and it may actually end up in a full blown later life lending product. But some of the drawbacks of later life lending products, as in equity release and Rios and so forth, is it is pricing, B, affordability. Because invariably, if you have a joint case, then the death calculations for affordability is not worked out on every person's applying. Also, as Stuart just mentioned, erosion of the actual capital within the property. If they're not servicing the loan, it's a gross roll-up product. Also, limited portability, because these products are designed to stay where they are. They're designed to stay there for the rest of their lives. And that's where companies like us, lenders like us who have interest only products, which are high street, just have normally RCs, fixed rates that everybody is probably used to using all their life. And they can probably understand that more actually going into later life sometimes, because it's just basically a same product. We just go up to 94 years of age on interest only, or if they want it on capital repayment, we go to 95. So again, it's also easier for the broker to explain to the client, and that it's just a portable product, keeping the price down. I think the one thing, going back to affordability, is where we do come in differently, is where we have the ability to get passive incomes from pension pots, investment pots, and property income as well. And that can actually power that mortgage right the way through to the 90s. So it's having that flexible approach in the background, which we can inform the brokers directly ourselves.
That segues really nicely into my next question, which was how does Family Building Society set itself apart from other lenders in terms of criteria and products? And I think the pension pot point is a really good one, because I don't think there are many other lenders who take that approach to pensions. Is that correct?
To be fair, there are more than us that would look at pension pots and investment pots in retirement. But the difference that myself, I kind of feel that we have when I look at the market is that when we look at, say, a pension pot, we would look at depending on the makeup of the actual pension and the age. They need to be 55 years of age if it was a pension pot. If it was an investment pot, same rules, but pretty much at any age. We would, if it's a 10-year term or more, we'd be able to look at that lump sum at 90% of the value. But the difference then is that the broker and the client get to choose the term. So whatever that 90% is, it's divisible by the term. When if you do go to a lot of other lenders, they will give you a prescribed percentage that you'd be able to use on for every year. But with us, you can extend the term, and that would reduce the affordability. You can condense the term, and you can increase the affordability. So we give you the chance to be far more flexible with those assets. And the one thing that I always try and kind of get in, I'm going to shoot on something in for you, is that if somebody had assets outside the UK but held within certain countries, then we can also use those for a UK resident application as well. So, because we've got an expat arm ourselves, so we can be really flexible on powering that lending later in life.
It's that kind of manual underwriting approach that you can look at things more holistically and you can be more flexible. Stuart, I don't know if you have anything to add to that in terms of how does Family Building Society set itself apart from other lenders?
Very much around the flexibility and the manual nature. One of the things I always say is that being a manual underwriting lender is both a blessing and a curse. We won't get a mortgage offer out with the speed of someone like Nationwide or other high street lenders are available. But what we will do is we will take a view on cases. So I try and encourage my brokers to speak to me about cases, even ahead of checking criteria or criteria related sourcing systems, on the basis that we will consider cases on occasion that are outside of our lending policy based on their merits. So it's always worth having that conversation with your local BDM, discussing the pros and the cons, giving us warts and all, so that we can then look at presenting that to our underwriting managers if it makes sense to do so. So we can do cases that otherwise wouldn't be considered. Yes, it's the flexibility of the pension pot. As Neil mentions, there are lenders that won't take it at all. Some will take it, but they want a track record of a certain amount. Some will use a certain percentage of it. We don't require to be drawing it at all. We don't require a track record of them drawing it. We just need to see that it's there and for them to be old enough to draw it. And then we can play around with the term in order to make sure that it fits for them, because we can use amount that's sustainable over the term of the mortgage. On top of that, there's other sources of income, such as rental income, which not a lot of lenders like taking, particularly if it's a primary source of income. But from our perspective, that's passive and can go up to age 95 at the end of a mortgage term. And if you've got incomes from limited companies that you're not involved in the running of, there might be a management structure in place, and the clients might be deriving an income from that in their retirement. And we're more than happy to take that as additional income as well. So it's the flexibility around the incomes. It's taking view on the case on its merits. Things such as whether it's a pound for pound remortgage or a purchase, whether the LTV is low or at our maximum, could all factor into the decision making process. And it's worth speaking to a BDM that understands what they're dealing with, in order to try and get those cases through where they wouldn't otherwise fit, particularly with the high street lenders.
I think we are nearing the end of our time, unfortunately. So I'm gonna ask you guys a difficult question to round up this episode. Is where would you like to see innovation in later life lending?
The innovation is going to be the transition of what I class as a high street interest-only lend into basically later life. And I know that there are kind of close to that out there at the moment, but it's not really, I think, a broadly understood and followed path at the moment. And I think that's where the products need to be. And it's also informing the client in that innovation, because at the moment, clients get to a certain age and they think that's it, game's over. They can't lend anymore, or they have to go into equity release and so forth. So I think the innovation is twofold: one, in product, and to, again, that wonderful word of education.
And Stuart, do you have anything to add to that?
I'm going to be a bit of a politician here,
Ooh.
and I'll answer a different question to one that you've asked. In terms of innovation in the product space, I'm not going to try and claim that we're there fully, but there's quite a broad spectrum as already discussed. One of the things that I think would be worthwhile is encouragement and education. So encouragement for brokers to get the qualifications required for later life lending in general. Obviously, one of the things we've touched on are the products available, and most of them don't require additional qualifications. Some of them do. By brokers going down the route of qualifying themselves for the later life lending market in particular, they can then offer the full suite of advice themselves. Failing that, there are then obviously, again, going back to the opportunities from the previous one, relationships that they can build with either equity release advisors themselves or with kind of packagers or master brokers that do have later life lending facilities available, because then they can have a look at the later life option, and if a standard mortgage is better, they can then pass you back to the original advisor. So rather than innovating products per se, I think that as an industry, we should try and get more people qualified on the later life side of things, just so that then they can make that full decision themselves on behalf of their clients.
I think that's a really important point to finish on. So thank you both for your amazing contributions. And, so I think the key takeaways are, later life lending products have their place, but you may also want to add things like interest only, joint borrower, sole proprietor, or repayment mortgages to your tool belt, just to make sure that you have the range of options for your clients. And Family Building Society has some very innovative criteria and flexible underwriting approach, which makes it great for your later life lending clients. So thank you so much. We have one episode left in this series, and please tune in for some more great insight.